What's up, friends? Welcome to Web3 Academy, a place for entrepreneurs, creators, and marketers to explore and learn how to use Web3 to transform business models and create thriving communities. Enjoy this next episode. GM, welcome to Web3 Academy. It is the weekly spotlight. I'm Jay Hamilton, and as always, my co-host Kyle Rehead is with me here. What's up, Kai?
What's up, friends? How's it going?
Today, we have one of my old friends on the podcast who is a reformed hedge fund investor turned crypto investor. We've got Mr. Sam Andrew. Sam, welcome to the podcast.
Hey, guys. Thanks for having me. What's up? And hey to everyone listening.
So excited to have you here, man. Give us a little bit of a bio on Sam. So Sam spent nearly a decade at BlueMountain Capital, a $22 billion NYC-based hedge fund. He was responsible for sourcing, underwriting, and overseeing investments. And now he focuses all of his time on crypto, taking a seasoned investor's approach to researching and understanding and valuing crypto assets, something that Kyle and I were both really impressed with when we started to read Sam's writing, which he's been doing on his Substack. We'll definitely be putting the link in the show notes. You guys are going to want to check it out. But really, today, we're going to dive into the business case for blockchains, understanding more, what is the value that blockchains create? Are they profitable? How are they profitable? What are their costs? What are their revenues? And are they sustainable? And where are they going? We're going to talk a lot about Ethereum as well, not because we're trying to be Ethereum maxis, but because Ethereum is a great example to use for a lot of blockchains. So buckle up. This is going to be an incredible episode that really, I think, is going to set a lot of foundation for a lot of people out there that are trying to get a better understanding of blockchains, which I know I am trying to figure out every day. So yeah, really excited to get into it. One thing I got to mention is Sam being an old friend of mine. Sam, you got one of the best laughs there is. So I really hope you treat us with your laugh today.
I like to think I'm like every comedian's best friend or biggest fan. Because it doesn't take a whole lot for me to laugh. So if you don't hear it, that may be more reflection of your poor joke making.
Pressure's on, Jay. Pressure's on. Here it is.
So I'm gonna just put some of that pressure back on you.
Totally fair. I'll accept that. I'm gonna start. I'll start working on my jokes now for the end. Okay, let's start as we always do when we bring someone on the show. Just give us a background, Sam, of how you sort of went down the crypto rabbit hole. When did it start? Why did it catch your interest? Why have you decided to spend your time researching and focused on crypto?
Yes. So as you mentioned in the bio, like I fit the mold of like someone in traditional finance, right? Or TradFi as it's kind of commonly referred to now. I did the like investment banking thing for a couple of years. I spent about 9 years at a hedge fund. And it was in 2017 that I like discovered crypto. And at the time, like crypto was Bitcoin, right? You remember, it's a bit ironic, but you may remember the like ICO boom, which was actually all based because of Ethereum, but like none of us knew any better. So like we thought about Bitcoin, right? And I remember being on the in the office, and like MSNBC was usually tuned in, and like you'd have prices and like market news and whatever, and all of a sudden they're like quoting Bitcoin prices. Like all of a sudden everyone on Wall Street was aware of Bitcoin, and I'd probably clued into it maybe a little bit before that foray, not a while before, but like reading the Bitcoin white paper and then trying to understand like what this was. One of my work colleagues at the time was also quite into it, and so we'd kind of go back and forth on it, trying to understand what it was. And like largely the rest of the firm like wasn't that into it. And then by like mid 2018, it was like, wait, what? Like, what was that thing that just like totally flared out? Like you said it was going to be a big deal, and now it's totally collapsed. And I was just like, ooh, yeah, okay, I guess I got that one wrong. But I think that was just, one of the early, at least for me, one of the early chapters. And it kind of piqued my interest. And subsequent to that, in the years subsequent to that, it remained kind of a hobby of interest. I would follow Bitcoin, then I got more into Ethereum, and it was just like, oh, this is like, you're into Bitcoin. This is like Bitcoin, but better. It's programmable, and you can do more stuff. So okay, I could look into that and start buying some Ethereum. That was mostly in kind of 2020, at the depths of COVID. Asset prices had just totally collapsed. I got time on my hands. I'm researching things. And then, so bought some Ethereum, and then all of a sudden, by the end of the year, certainly into 2021, I'm just like, oh my God, this is worth a lot of money. I should figure out what this thing is. And at the time, I was pursuing a few different entrepreneurial ventures, and so crypto remained like a hobby, something just of interest that I kept going back to. And then, finally, towards the end of last year, I was just like, man, I've been following this thing for 4-5 years. All of a sudden it dawned on me that this is where I need to be spending all my time. And I think that was kind of one of the questions you got to, is what kind of got that was the kind of arc of how I got to crypto. But why I'm kind of committing all my time to it now. And there's a number of reasons. I'll just kind of flow through them, because I think it's interesting hearing from the different folks in the community how they got to it and why, and certainly why they're sticking with it. So for me, it starts with just I think this is potentially a revolutionary technology, and it's really feeding my curiosity of learning a ton about this stuff. And it's super fun, and the community you meet in it is a real driver. And I know community gets kind of thrown around a lot. And for me, what that really is, it's just this band of misfit trailblazers. There's a bunch of really smart, but also eclectic people that some came out of, traditional finance in my capacity, but a lot of really smart engineers and software developers out of really noteworthy either companies, institutions. But then there's also I meet guys on Discord that are just so well known, or know so much about the space. And they're yeah, man, I hang drywall 9 to 5, and I do this in the evening. Or another dude I met, he's a retired, he's an entire retired Navy pilot in his 70s. And he's got some weird funky handle. And he's just it's just so strange, the people you meet in the space. And I can't help but laugh and or laugh with them, and it's just so fascinating. So that's what really drew me in. There's also, quite frankly, a bit of a regret minimization of if I think forward 5 or 10 years, and it ends up kind of crypto, Web3, however you want to call it, ends up being as big or nearly as big as the internet, I will regret not being part of it. Right. And I think through already the arc of my career when there was one massive, structural, mega tsunami shift, right? And that was the internet in the kind of 90s into early 2000s, which I was in school during that time and aware, but I wasn't part of it in a professional sense. And then the second kind of big shift was, into mobile. And into mobile, I was very much, in the professional world during that period, and watching it and kind of participating kind of at a distance as an investor. And there's this realization of man, I started 2 big waves in my life so far. I don't want to miss the third big wave. And so it's just I got to be part of this, and to be part of something that I think can have a pretty meaningful impact on the world, for me is just personally really fulfilling. And I also think I can be a pretty valuable contributor, and you put those 2 things together, that it gets me up in the morning.
I love it. I love that so many people talk about when they came in, and what would have been the third crypto winter, 2018 was when it started, I think was when a lot of people came in right before then and then fell off. And so we lost a lot of people. And now here we are again, entering or in the fourth crypto winter, but there's a different energy this time, right? There's a building energy. You talked about community. I have numerous stories of the same, of meeting completely eclectic, different background people, all with this thirst for learning. I think is really the common thread throughout, this desire to be on the forefront of innovation, and to be part of, as you said, I really like that term you use, regret minimization. I haven't heard that one before. To be part of something early on that is a really potentially, going to change the world. At least that's the way we believe it'll lead to. Yes, really, really agree with a lot of the threads. Let's jump into, go ahead.
You know what, let me just pause on that regret minimization. I found that to be a really good framework to think through big decisions, certainly big personal decisions. I can't totally claim it as my own. There's this fascinating Jeff Bezos 60 Minutes interview from, I don't know, probably sometime in the early 2000s, like early days of Amazon. And he talks about, he was also former hedge fund guy at D. Shaw, and like a really big, well-known hedge fund. And he laid the case to his, the founder of the firm that like, I'm going to leave to go do this. And the founder of the firm was like, you're nuts. Like, do this either internally or like, but you're working on this hedge fund, you're gonna make all this money here and it's gonna work. And like, he's like, yeah, but I know if I forecast myself in 5 to 10 years time and I don't do this, even if it fails, I will regret not having at least tried. And that's, I find, a very good lens to think through longer term decisions.
That's great. I love that. Look at great tips, great life lessons coming from Sam. Oh, this is awesome. I thought you were going to talk about the time we went to Tony Robbins, maybe, but that's a different story.
Oh, well, that's for the next
Lots of life lessons came out of that. Okay, let's start with a quick summary of why blockchains are valuable. So you wrote a post on this. We highlighted this post on Monday in our newsletter, and Kyle did a full reading of this post on Monday. So if you haven't listened to that podcast, recommend you go back and listen to that if you want to understand a little bit about why blockchains are valuable. But give us just sort of the summary of that, Sam, to start off.
Sure. So let me tell you about how I kind of came to this thinking of like why blockchains are valuable. I got like really drawn, as I think a number of people, kind of drawn into the hype, the innovation, and like things are just moving so rapidly that you're kind of always like jumping on to the next thing. And I realized that was a bit kind of miscalculated, of almost like taking a step back and like a very much kind of first principles approach to like what this thing actually is and why is it valuable. Because I think a lot of people talk about blockchains being valuable in anticipation of what may come, right? Of like, oh, blockchains can disintermediate the payment system. They're going to revolutionize the art world. They're going to, obliterate traditional finance and like all these things of like when blockchains achieve X, then they will be valuable. And although that may be the case, that they may do one or many of those things, that is like proof down the road, right? And that's going to be confirmation, but it's confirmation of things that exist today. And so what are those like features that exist today that are inherent in the blockchain that make it valuable? And I think that's what's most interesting about why a blockchain is valuable. And to me, there's like 4 key features. 1, it's decentralized. 2, it's functional. 3, it's composable. And 4, there are native economics, right, in the form of tokens in the blockchain. And those 4 things together produce what I've called like the innovation super cycle. And the innovation super cycle is effectively this breeding ground of innovation that has this feature set, unlike a feature set that existed in any other prior era or development medium, that makes it especially attractive for developers to develop in, for community builders to be a part of, for artists to be a part of, for financiers to be a part of, for users of all different types to be a part of.
Sam, I love the innovation cycle, or the super innovation cycle. Is that what you call it?
The innovation super cycle, yeah.
Innovation super cycle. Sorry, I love that. I think we see that's exactly what's coming here with crypto, with Web3, and I mean the reason this all happens is because of blockchain, right? I want to flip the switch a little bit here now, and just start talking about like blockchains and how these things actually function or work in terms of just like its revenues and like it's just sort of like business models around it, because ultimately you know, these things are great, and everyone, like, I think everyone agrees that blockchains are valuable, but I don't think people really understand the underlying like metrics of this all. And I think you just wrote a really good article on sort of I think you called it the business case of Ethereum in this instance, but we'll sort of talk blockchains in general. So let's just think of this like this. Blockchains are a business, right? They sell block space, right? Just like Apple sells phones, and, you know, Facebook sells ads, et cetera. Blockchains sell block space. So can you just sort of walk us through like why some blockchains are more expensive than others? And we can think of maybe, you know, that as like revenues for the blockchains, but like, why are some expensive? Why do some charge more? Why are some super cheap? Like, how do we differentiate between that?
Sure. So why some, like, maybe let's first start with like, what is revenue for a blockchain? Right. And just like a regular business, revenue is based on the product it sells. And that revenue is a product, I guess no pun intended, but like a product of price and volume. And in this case for blockchain, your price is your gas price. Gas price is just a kind of crypto term for the fee it costs to process a transaction. And then the number of transactions, right? Gas fee, your gas fee times the number of transactions, that yields your revenue. Simple as that, right? And then it's like, okay, what's the cost base? Well, cost base is, think about like proof of work networks. Your cost base is the cost for the miners to process that transaction. And so if we take Ethereum as an example, and most kind of work a similar way, certainly proof of work networks, then pretty much all the revenue you generate in transaction fee, 100% of that gets paid out to miners to validate those transactions, right? To ensure the integrity of those transactions. Not only do all the revenue gets generated, gets paid out to those miners, in addition to that, you're constantly issuing them new tokens, right? So think of it even just from like a business standpoint. All the revenue you're taking in, you're paying out in cost, call it like cost of goods sold, right? To process those transactions. And in addition to that, you're continually issuing new tokens, right? Or in the case of a business, continuing issuing more equity, so that's diluted to the existing owners, to run the network. So you're like, this thing is not profitable. Not only is it not profitable, but like, how is it ever going to be profitable if the revenue matches the costs? They're the same. Mm-hmm. And I keep issuing more tokens. There's massive dilution happening, mm-hmm. right? Like, why is this thing economically valuable?
So hold on, when you're talking about profitable, let's try to break this down. We have the revenue, which comes in as a result of gas fees. So people paying to use it and to use that block space. Right. So that's the revenue. But what you're saying is, I guess there's two expenses maybe or all that revenue, one goes to the miners, right? To pay Correct. For them to actually like validate. And then you're saying there's a second expense, which is basically the inflation. I don't know if you want to call it inflation, but is the amount that the blockchain, I guess, is paying to the miners for them to issue new tokens. Can you explain that in a little more detail?
Yeah. So let me explain that second one in a little more detail. If I'm a miner, I get two revenue streams, right? I get, my gas fees,
yeah,
right? And that's the cost, my cost of processing transaction. But it's almost as if that in and of itself is not enough to offset my own costs of running my mining operation. So in addition to that, I get given, in the case of Ethereum, 2 new ETH per block. And a block is simply just a whole bunch of transactions.
Mm-hmm.
So those are the two costs, right? Both involve including ensuring the security of the blockchain, but those are the costs of operating a blockchain.
And
right.
And just to be clear here, why these costs are being spent, and really the value of a blockchain is the security that it's offering. And we're going to talk later. We're talking currently about the miners and proof of work, and I'm just going to tease that at some point we're going to talk about the merge and proof of stake. I don't want to jump into that right now, but really what we are talking about is there's a lot of value in security, right? People want to pay, coming back to this why are blockchains valuable that you talked about earlier, people are willing to pay to have secure digital property online and secure transactions. So there's value in that outside of the profit and loss.
Yeah, Jay, that's a great is a great point you made. One we probably should have started with, of like, what are the costs that we're incurring, right? Why are we incurring these costs? It's, as you pointed out, security. I would also posit that like it's also just like processing the inputs, right? Processing the transactions. But ultimately, like, blockchain is all about security.
So
right, you may be selling block space, but you're really, like a brand sells more than its product. It can sell a lifestyle.
Yeah.
A blockchain sells more than just block space. It sells security.
Right. And okay, so it sounds like proof of work anyway is not necessary. And I think as we dive into proof of stake too, we're going to see the same thing, but like none of these blockchains seem to be very profitable, right? They're issuing lots, and we're not making, or they are not making enough revenue to pay for these expenses. Now, does this really matter? I mean, a blockchain doesn't necessarily have employees. I guess maybe you could say the miners are its employees, but not really. It doesn't really have any other expenses, and not like it needs an office and it needs to pay for, pens and paper and whatever else. I don't know what offices pay for these days, but like, do blockchains need to be profitable? And if so, why? Can you kind of dive into that?
Yeah, blockchains absolutely need to be profitable, right? At least there needs to be a path to profitability. Right. And Kyle, you're right. No blockchain is profitable now. They're all burning millions of dollars a day. That's a problem, right? It's because their costs are way bigger than their revenues. And yes, a blockchain needs to be profitable, right? And it absolutely needs to be profitable in my mind, because otherwise, why do you want to mine ETH, right? Or why do you want to mine or validate? If we're kind of starting to use proof of work and proof of stake interchangeably, which we'll probably get to that at some point. But why, if I'm a miner or a validator, that is critical to ensuring the integrity and the security of the blockchain. If I'm not making money doing that, why am I doing it? Right? I've got costs to mine this blockchain, right? And if the chain is not profitable, then it loses security. And once it loses security, it loses kind of the confidence of the people that are operating that network. And then fewer developers come and develop it, and then fewer apps get built on it. And so the whole thing unravels pretty quickly. So that's why having profitable blockchains, right, or certainly a path to profitability, is tantamount in ensuring the security of the blockchain.
Now, can't the price of a token just go up anyway, even if it's not necessarily profitable from the underlying fundamentals? Price could, I mean, if you look at Solana, for example, I'm just looking at daily issuance. Their daily issuance of their expenses is basically close to $5 million a day, just to pay this is proof of stakes. This is to pay their stakers, not their miners, but they make basically zero in revenues because they have almost no gas. But I mean, their token, I mean, I guess not recently, but had continued to go up for a while. And so like that pays the stakers and makes them happy. So like, is what I'm saying is like, is the token price then related to the profitability of a blockchain, or is it just something completely different?
You may not like this answer, but it depends.
Okay.
Because there's two things that will drive that. One is that proof of stake versus proof of work. And And then also the scaling ability, particularly of the cost structure of whatever blockchain we're looking at. Those will drive the kind of profitability and ultimately kind of where the price is going. I think maybe if we use Ethereum as an example, that will maybe help kind of tease things out a little bit. Okay, so we talked about, kind of Ethereum not being profitable right now and why it needs to be profitable. And so, in this case, like, what do you actually own if you own like an Ethereum coin? Right now, it's like you own currency, right? Currency in the native Ethereum economy, because to do anything in Ethereum, it requires ETH. And in my opinion, you also own like a speculative token, right? Because there's no fundamental value. The value that is created on the Ethereum blockchain does not accrue to the ETH holders, right? Because as we went through, like, all the revenue gets eaten up in costs and then some in the form of dilution of additional tokens. And so people own ETH on the belief that like something is going to change, right? And they have actually pretty good reason to believe something is going to change, because it's actually been like telemarked for like the last couple of years that like we're implementing EIP 1559, which was implemented last summer, right? And that had been forecasted. And then we're going through what's called the merge, right? And that had been talked about since even like prior to 2020. Like, it's been a couple of years in the works, right? And so markets are generally forward looking, and so they're anticipating like kind of big changes. And this merge, in my opinion, is a huge deal. And it's a huge deal because all of a sudden Ethereum becomes profitable, and the value that gets created on the Ethereum blockchain starts accruing to ETH token holders. That's a huge deal, right? So when I refer to the merge, what that means is Ethereum is currently proof of work. Proof of work is a consensus mechanism that allows miners, which are the people that effectively run like big time computers, to ensure that each transaction is like properly inputted on the blockchain. Whereas and they get paid per, they get paid 2 ETH per block, and a block is a whole bunch of transactions. Proof of stake is a different consensus mechanism, right? Whereby now we call them validators. They validate, instead of miners, they validate transactions, and they get paid based on the amount of total ETH that is staked. And staked ETH, think of it as like a security deposit. I will put up a whole bunch of ETH, and I will go and ensure that these various transactions are correct. And if I falsely say that a transaction is correct when in fact it is not, then my staked ETH will get burned, get slashed. And what that slash means is effectively like you lose it. You were a bad actor, and so the ETH that you staked as a quote unquote security deposit gets taken away from you. And so this merge is a huge deal, right? I talked a little bit about how it changes the cost structure, but it's a huge deal. 1, because it's more secure. 2, because it's environmentally more friendly. And 3, because it's economically viable. And we can touch on all 3, but probably we want to focus a little bit more on the economic viability of it. And going back to Kyle, to your question of like, well, how does this affect the ETH? The ETH price is, or just token prices in general. A lot of them are driven off the speculation that something is going to change. And in the case of Ethereum, like something is changing, and something has been in the works to change for a while. And that is this conversion from proof of work to proof of stake, which all of a sudden makes the blockchain profitable, and the value that accrues on the blockchain, or to Ethereum in this case, will accrue to the token holders. So it means the more revenue, the more the adoption, the more the gas fees, the more the revenues, much lower cost base, that value, it becomes profitable, and that value will then accrue to ETH token holders.
Can we sort of, I don't know if you have the numbers handy. I know you had them in your article, but I'd love to sort of dive into the difference here of like the revenue and expenses from proof of work to proof of stake. Because I think like what you said, one of the biggest changes here with the merge is the tokenomic structure. It's not going to lower gas fees or anything like a lot of people think. It is to go green, like you said. So we don't have all that energy anymore, but the really big unlock here is this change to tokenomics, right? It really significantly reduces expenses and thus makes Ethereum profitable, which thus is then good for the ETH token price, which thus is good for this people securing the network, right? Which is all the things we want. We need that in a blockchain. We've already kind of established that. Can you walk us through, because the changes are actually like massive. Can you sort of walk us through those numbers or just like what you're seeing with the change from proof of work to proof of stake?
Sure. So there's kind of like two steps that are happening here, one of which has already happened, which is the EIP 1559. So let's just think like simple proof of work. You get a certain amount of revenue in, all in the form of gas fees, all that goes back out to pay the miners. And then in addition to that, you issue them new ETH tokens. So simple numbers right now, and I think putting numbers to this will help just illustrate how big of a change this is. Right now, there's about, give or take, it can be pretty volatile out, let's say like 3,000 in daily ETH revenues, right? So that 3,000 is revenues of ETH coming in, and then that's 3,000 getting paid out to miners. Let's assume for the simplicity's sake, EIP 1559 does not exist. In addition to that, Ethereum issue about 13,000 ETH tokens, right, to produce that 3,000 of ETH in revenue. Right now, let's talk about EIP 1559 for a second. What that means, how EIP 159 changes things is instead of the entire amount of gas fees being paid to the miners, the gas fee is split in half. There's what's called a base fee, which is kept by the network, right? I think of it kept by the network, and then it's used to burn ETH. So what does that mean is that now all of a sudden part of the revenue is kept by the network, and I'm using that kind of kept in quotation marks. It's not technically kept, but for the sake of this explanation, it makes it a bit easier. And then it effectively retires that ETH, right? What burns it means it's retiring. It takes it out of the number of Ethereum or ETH tokens outstanding. So what's resulting, like there's fewer ETH tokens outstanding at the end of that burn mechanism. And then the miners get paid the remaining portion of the gas fee, which is called the tip, right? And the tip is like, you can pay more if you want your transaction to be processed faster. Think of it that way. So now when we get to proof, we get implementation of EIP 1559, this burn mechanism, right? And then proof of stake at the same revenue of about 3,000 ETH per day. Now all of a sudden, you're keeping about 85% of that revenue that's coming in, right? Think of that as like your gross profit, right? And so the other 15% is what gets paid to in this case, the validators, right? That's their tip. So now you've got a business that's running at an 85% gross profit margin, right? And then in addition to that, you still need to issue tokens, right? But you're going to issue tokens to the validators based on the amount of ETH that's staked, right? And now we can make different assumptions as to how much ETH is staked and so forth, and we can get into that. But we've got a sense of that right now because there's on this kind of test chain, there are a number of validators and we know the kind of yield that they're generating. So we have like a pretty comfortable assumption as to what that could be because there's this test case. And so in the proof of work, when you're issuing 13,000 new ETH tokens per day, right? Which is why I was so loss making. Now, or soon to be under proof of stake, Ethereum will issue about 1,700 new ETH tokens per day, right? So
wow.
That's huge. That's like a 90% reduction.
Yeah.
Right. And that's enormous. And so all of a sudden now, Ethereum is profitable. And then so those profits, how that accrues to the ETH token holders is ETH gets burned. Think of it like as a share buyback. All of a sudden, ETH gets retired from the network. There's fewer ETH outstanding. So if the network value remains same value, the value per ETH increases because there's fewer ETH outstanding, right? So that's a huge deal.
Basically what you're saying, I'm trying to figure out ways to put this into easier terms for people to understand, is like, imagine a business where it's going to have the same revenue as it had last year, but this year it has a 90% reduction in expenses, and it's buying back, I don't know what the percentage was, but whatever amount of its own shares as well, right? So it's like, it's an insane, I guess, when you think about price of tokens, and this could be true of anything, whether this is the US dollar or equity or whatever, it's all about supply and demand, right? And so any unprofitable blockchain is just inflating, kind of like the US dollar, right? Our US dollar inflates and it's worth less. That's because it's just inflating. There's more supply. And so every blockchain is just creating more and more supply of its token. And eventually that means price is going to have to go down. But ETH, with the merge and with the EIP 1559, is about to go into a world where it's no longer still creating new ETH, but net, it's actually decreasing every single probably day, I guess, because it's burning so much and it's issuing way less. Does that sort of make sense?
That is correct, right? All of a sudden you've got your same revenue, costs are down by about 90%, and you're gonna have fewer ETH outstanding, which also kind of begs the question, like, how is cost just going down 90%? Like, what just happened there? And I can kind of explain that as well, because that's like, you're like, oh my God, this is so profitable. And like the use case for ETH is still there. We already talked about like why, kind of blockchains are valuable, and we get into ETH and Ethereum in particular, but maybe that's a separate discussion. So revenue is still the same, cost structures drop dramatically. And so like, why is that? And the reason is because simplistically in proof of work it's the race to do the work to ensure that the transaction was properly inputted, right? It's the first one that gets there. And the way you can increase your odds of being the first one to get there is get a ton of computing power, right? And so it's capitally very intensive. These are not just like our laptops that we're having this conversation with. These are like specialized, very expensive computers that are used to do this, to process things incredibly quickly. Not only is there a high capital cost to doing this, but there's also a high operating cost, right? To run these computers, you need a lot of electricity, right? And so you generally want like cheap electricity, but that's also why the term mining is actually somewhat similar to traditional like resource mining, right? Like blockchain mining is similar to traditional resource mining in the sense that it is incredibly capital intensive, right? It is also incredibly energy intensive. And as a result of those two things, it's terrible for the environment. So you're like, that's the existing cost structure under proof of work, right? For miners. Now pivot to the cost structure under proof of stake, right? Well, proof of stake is not a race, right? Validators and proof of stake get chosen at random. So having all this high, expensive computing power doesn't actually help you when the whole thing is random to begin with, right? And it's done in such a way that the computers we're using to have this conversation on, that's a computing power that's enough to generate block validation.
I think that was a great explanation, by the way, to explain why I actually didn't even, like, that was really, really good. Hopefully that helped the listeners to understand as well. The other big difference between proof of work and proof of stake that I've seen is, okay, so for any price of any asset, it's all about, again, supply and demand. How many buyers are there versus how many sellers? If there's more sellers, right, then price goes down. If there's more buyers, price goes up. In proof of work, because of what you said, it's resource intensive. They have to pay for this equipment. They have to pay for this electricity. All that Bitcoin that's getting, Bitcoin or ETH, sorry, we're talking Ethereum here, but ETH and proof of work that's going to these miners, they actually have to sell that ETH because they need to pay for electricity, they need to pay for their equipment, et cetera, right? So that's a lot of sell pressure on ETH, the asset. Whereas when you switch to proof of stake, like you said, it's not energy intensive at all. They can just run it on a laptop. It doesn't take a lot of electricity. And so now you have, I mean, one, a massive reduction in the amount of ETH that you're giving to these people, but also they're probably not selling it, or like, why do they don't need to sell it. They don't have to pay for much electricity. They don't have to pay for much equipment. So you also just have so much, a massive reduction in sell pressure on ETH token itself from this, which in my opinion, and I don't know, you're the investing experts, you tell me, also is very bullish for the price of the token, which again is good for the security of the entire network, right?
Yeah, Kyle, you hit the nail on the head there. Like this, you know, from an investing standpoint, we can talk about whether or not this is priced in and how to think about that. That's maybe a separate discussion. But like, this is there's so many facets as to why this merge is a big deal. This is another one where all of a sudden you go from Ethereum in this case being a structural sell market, right? Miners need to sell every day the ETH they get issued in order to pay for their dollar denominated cost of running their mining operation, right? Right now, I estimate that about 75% of the ETH that is issued to the ETH tokens that are issued to miners get sold, right? To fund their operating costs. So that means there's about 7,000 ETH on a daily basis that are sold to cover costs. That equates to about $13 million a day of sell pressure, right? Which, you know, you accumulate that, that's about $4.6 billion a year in sell pressure. If you think about it another way, there's $4.6 billion worth of demand that needs to be created to keep the ETH price constant. Right now, when we move to proof of stake, because it becomes profitable, right? It becomes profitable mainly because of the cost structure we just walked through of how it's being totally inverted. And because of this burn mechanism through EIP 1559, where all of a sudden it's buying back ETH, right? So one, you don't have, the validators don't really need to sell much ETH. I assume, you know, they sell 10% of the ETH that is being issued to them. You know, so that means, and the improved profit, you know, with the improved profitability and the buyback or the burn mechanism, now all of a sudden there's about 2,000 of ETH a day, or about $4 million. This is all kind of assuming a $2,000 ETH price of buy pressure a day. So on a net basis, right, you go from that sell pressure, you know, call it minus, you know, $13 million of sell pressure. Now there's a $14 million buy pressure. That's a $17 million swing, right? In buy demand on a day per day, right? That's 6.3 billion annually. That's a big deal, right? And you think about it, just both the terms like absolute numbers, but then also you want to like contextualize this, because the ETH market is still pretty big, right? It still has a $200 billion market cap, and on daily volume, it does, you know, about 2 billion a day, something like that. So you're talking about like 1%, you know, the $17 million buy pressure that we just got to, that's about 1% of the daily ETH tradable ETH volume. That's pretty big, but it's not like, you know, I want to put this in context. Like it's not, it's something to pay attention to, and it's big, but it's not like gigantic. But certainly something to be aware of. And there's other buy pressures as well as a result of how we think about staking and so forth, that are actually probably an even bigger deal than this. But maybe a kind of separate conversation, because then we start getting down the rabbit hole of
a lot of rabbit holes,
and the merge.
Sam, I wonder if you can add to this a little bit more. So I just want people to understand, like, one, okay, this sounds super bullish for ETH, which is great. Yes, we all want our bags to go up. That's not really why Ethereum, the network, is doing this, is merging. One, it's because you already said it is more secure. Proof of stake is just a better way to have decentralization, et cetera, and security versus proof of work. I think this whole tokenomics discussion is important to get right, because if you can flip it, like you said, where now there's all this buy pressure instead of sell pressure, and the ETH price goes up, this means the market cap of Ethereum goes up, which is also a big important vector for security, because if you have a very, like, let's say your market cap is 20 million, it's fairly, or 20 billion, let's say, whatever, it's someone can, like a nation state, could buy up half of that and take over the system, right? They could take over and hack into the blockchain essentially, because they own control of it. Whereas the more value or the more expensive that market cap, or the higher that number is, it's harder for nation states or whoever, bad actors, to be able to accumulate enough to make an impact and do something bad to that network. And so I think another reason why I think the Ethereum community cares so much about price is not because of their bags, although I'm sure that's a thing, but it's actually to increase the market cap, because it means that it's more secure. I don't know if you have anything else to add to that, or what your thoughts are on that as well. I just want to make sure listeners are like, we're not just trying to shill bags here. We're actually just talking like it's better for the entire ecosystem if number go up.
Yeah, so higher, there's a couple things on security. You're right. The higher the ETH market cap, the more expensive a 51% attack becomes, right? It's more expensive. It costs more money, right, to go buy the amount of ETH you need to own to launch a 51% attack, than buying all the computing power that's required to launch a 51% attack in the world like proof of work and mining. There's a second facet that improves security as well, and that is because mining no longer requires is heavy computing power and is that capital and operationally intensive, and it's designed for anyone to do it, you're going to have a lot more validators, right? Ethereum right now on the Beacon chain, is this like test chain that's been operating for like a couple of years that they've been testing all sorts of proof of stake stuff on. There's about 400-ish thousand validators right now, right? And I expect like that will go up, because like literally on the computers we're using now, we'll be able to validate ETH, right? And so that means you can have what can happen or like has been happening in proof of work mining operations is they become more consolidated, because it's no different than any commodity business. Like scale is really important, and you get to scale through consolidation, right? And so that consolidates the number of miners you have, but like in the proof of stake, there's not really a scale benefit. Right. So you're going to have a whole lot more validators, and so it's like it makes it safer and more secure as a result.
So this brings up the question: every other smart contract platform is already proof of stake. Why are they not profitable? And are they on track to becoming profitable? Do they have this, like you said, Ethereum is not profitable, but it's like you can see it, it's coming. They have a roadmap for it, so that's cool. And its roadmap really is going proof of stake, and then also it's EIP 1559. Why do none of the other blockchains? Why are none of them profitable?
Short answer, I don't know. I've got like hypotheses as to why that is the case. One, like the burn mechanism for Ethereum is particularly important, because that's a way of distributing value back to Ethereum token holders. And so that's pretty critical. So that's like in my mind, a pretty big differentiator. And then also, you got to pay attention to like the economics of how tokens are issued based on the amount of tokens staked, because that's also different across different chains, right? And so how Ethereum is structured, they have like a very clever kind of sliding scale mechanism as to how much ETH gets issued to validators, that ensures the integrity, like the security of the blockchain without overpaying for it. So those are usually like two factors that I would highlight. That's all on the cost base, right? And then to think of it from like the revenue standpoint, it becomes a product of like price and volume, right? some of these other rival chains, you know, they have much lower cost per transaction, and that's their selling feature, right? Which is actually can be very useful, but you need massive volumes to drive that.
Right.
I
actually have the numbers up for revenues here on crypto fees from David Mihal, who we had on the podcast once. And so we look at revenues. Ethereum is earning 6 million a day, basically on average for the last 7 days. And then in comparison, Bitcoin is 446,000 on average. And then you have Avalanche at 42,000, Polygon at 27,000, Solana at it's not even on this list. I don't even know where it is. It's under 15,000. So I mean, they just basically have no revenue, right? Which I mean, like you said, it's a good thing for the users, but it's terrible for the overall business case of the network, right?
Yeah, I wouldn't necessarily describe it as terrible, but it's not sustainable.
Right.
Okay. And so if there's a path
so
to change that. I was doing some benchmarking on this a little while ago as well. And I reckon, Bitcoin's probably losing $30 million a day, Avalanche about 2 million, Solana 4.5 million. Wow. Right, looking at their revenues and their cost base, it's big numbers.
I just want to take a step back and celebrate the fact that you said "I don't know" on this podcast, because we really celebrate those 3 words a lot. You talked about in the beginning the cooperation that happens in this space, and I think cooperation happens because people say things like "I don't know," and we all learn together. And yeah, it's an important mindset to have. I think there's when we're innovating in a super cycle, as you mentioned, the way we are, there's going to be a lot of blind spots, a lot of learning to go through. And yeah, I've got to give you a shout out for the "I don't know." I hope more people and our listeners embrace that attitude and aren't afraid to say what they don't know, because that's okay. And that's a good thing.
Yeah. Well, thanks, Jay. Maybe just double tap on that. There's a lot more than that I don't know that I do know. And I think my experience as an investor it can be quite humbling, because it's the things you often think or take for granted that end up not being so. That's where you really get screwed. And so you got to be able to just be yeah, I don't really I don't know how this works. And that's kind of impetus to go figure it out. Yeah. But that's also an impetus realization hey, that's a blind spot.
Yeah, that's a great point. So I want to start to wrap it up here for the sake of time. But I think one thing that was important just to kind of note of this is so we say Ethereum is about to become profitable. None of the others are yet. One thing to keep in mind is Ethereum has been around since, when was its genesis? 2016, 2015 kind of things.
14.
It's had a lot of time to also, Ethereum didn't know how it was going to become profitable at the beginning either, right? And it's had a lot of time to research and learn and change things and figure this out. And so what I was trying to get across was not okay, everything else is not profitable, don't think about anything else, it's only Ethereum because it's the only profitable one. It's just that the rest are new, and it takes a lot of time, and you got to get a lot of things right, it sounds like, to make this work. But to come full circle, one of the things you said was we want these trust guarantees. That's what makes this so valuable. And thus we need sustainable networks that are going to be what's the point in building on a blockchain that's going to be non-existent in 2 years from now? You know what I mean? We need to make sure that as developers, as builders, as entrepreneurs, we are going to put our efforts on something that is going to be around for a long time. And it looks like Ethereum is one of the ones that has been able to, or hopefully is able to figure that out. And the rest, I mean, a lot of these other ones, all the names we said, Avalanche, Solana, they're only a couple of years in existence. So I'm sure over time they will find what the things that they need to do to become profitable and sustainable as well. At least we hope. That's kind of the hope of this whole space.
Yeah, and I suspect they'll get there faster, right? Because all these learnings kind of compound on one another.
Exactly. Exactly.
right? Just like
Composability.
Solana was able to launch much faster than Ethereum was because they already had kind of like the roadmap from Ethereum, right? And same thing,
Right.
Ethereum was able to launch actually pretty quickly relative to Bitcoin because it was like, well, we're going to do Bitcoin, but it's going to be like slightly different. It's going to be programmable, but we're still going to use like proof of work because like that's how things work, and like it, you know, it's tested, it works. And then they later just, you know, later discover like, oh, maybe we should change this proof of work thing, this proof of stake thing. This is actually probably going to be better. But it's taken like several years to go from proof of work to proof of stake, and we're not quite there yet.
Right. Okay, so the elephant in the room is, what about Bitcoin? This one's been around longer than everything else, and it's still proof of work and still not profitable. Does it ever get there?
In terms of profitability, no, but the use case for Bitcoin is, in my mind, very different than the use case for like any other programmable blockchain. Right. And that's why I was like, from the top, it was very good that we delineate between programmable blockchains, which is kind of everything else but Bitcoin. In my mind, over the last few years, all the use cases for Bitcoin, with the exception of it being a store of value, have been refuted, debunked. Like it just like doesn't really, you can't do a whole lot with Bitcoin. And even, you know, I put like store value in air quotes because in my opinion, it's not really a good store of value. Or I would bifurcate that. For most people in the world, I should say people in the developed world, it is not a good store of value. And it's not a good store of value because there's other competitive store values, gold, painting, real estate, like whatever. And if you're worried about inflation, then you can go buy commodities and equities and various other things. Whereas, you know, if you're not living in the developed world, if you're like in a more despotic regime, then all of a sudden, you know, you are really worried about the government taking your money or hyperinflation, right? In most of the Western world, like we're not worried about those things. Like, yeah, we're worried about inflation now, it's like 8%, but like in some emerging market, you have like 6% monthly inflation, right? That turns into like 100% in a year. Like that's hyperinflation, right? And so all of a sudden, a 30% drop in the price of your store value assets, like, dude, it doesn't matter because the alternative is so dire. I'm not willing to go there. And so that's, in my mind, the use case for Bitcoin or the store of value for a lot of people in emerging markets that where, you know, hyperinflation and the government seizing your assets is a very real threat. And that's still like a really big market, right? There's about $480 trillion worth, right? In the world. And I estimate about like 60 trillion of that is in like quote unquote despotic markets. That's like a really big market for Bitcoin to go after. So that's kind of that's my view on Bitcoin.
That was the greatest, simplest summary of Bitcoin as a store of value I've ever heard. We're gonna have to take that one out. That was awesome. One thing I want to mention that we talked about is like, so we've talked about how ETH becomes profitable. We've talked about how we're moving from a sell market into a structural buy and the buy pressure. But we haven't talked about the burn and the ETH outstanding tokens and how that economically affects. I just want to touch on that before we wrap up. And I know we also want to get a price prediction for Ethereum from you at some point here, which I'm sure our listeners want to hear too. Not that we're trying to be ETH maxis here, but.
Okay, so you want to just elaborate a little bit more on the burn mechanism? Was that?
And just the total
price predictions.
And the total supply, how that will flip when the merge happens, assuming the merge happens in August is the current prediction. Feel free to correct me on that. Yep. That's my knowledge.
Okay, so we touched on a bit how like the burn mechanism works, what it does, how it's funded, and so like the outcome of that is I anticipate to hit the kind of maximum number of ETH tokens outstanding probably later this year, around 120 million, based on, you know, the latest estimate of like an August merge. And once we move to like this proof of stake consensus mechanism, then I suspect between kind of 0.5% to 2% of ETH will be removed from circulation every year.
Okay.
Right. So think of it as kind of like deflation of like 0.5% to 2%. And what really drives that, there are two main inputs that drive that. It's the percent of ETH that is staked and what the daily fees are. Right. What the sorry, when I say daily fees, I mean like the daily revenue of that Ethereum is generating.
So we have an asset that's decreasing at 2.5% per year. You're saying that's pretty incredible. Do we see that anywhere in like traditional markets?
Sorry, I would say it's going to decrease by like 0.5% to 2%, something like that. And again, it's like there's assumptions that go into all these models, and we can link in the show notes to my latest piece. And in that piece, I have like links to these different models if you want to go in and kind of like nerd out on how I'm deriving some of these numbers. Like all those Google Sheets are available.
Have we ever had an asset that's deflationary? Like you know, I mean, the Bitcoin thing was like, okay, there's only 21 million. There'll only ever be 21 million, and that's cool. Do we have any example of something that's deflationary in an asset? I have no idea. No,
there isn't. You know, the like main thing that people would generally quote as like, you know, why gold is a store of value is because it's not an inflationary asset. They tend to think of it as not an inflationary asset. It's not really true. Like you can go and mine more gold. There's only so much gold in the world. Oil would be something similar. There's only so much oil in the world. Like a lot of the commodities tend to be thought of that way. But the reality is like, you know, you can flood more into the system. And so maybe I should just kept the short answer. The answer is no. And people may have come across this like kind of moniker of like Ethereum is becoming like ultrasound money. And where that was derived from is Bitcoin being sound money, in the sense that like it's only every 21 million Bitcoin tokens outstanding. And whereas everything else is inflationary. And with the burn mechanism and with proof of stake, Ethereum all of a sudden becomes deflationary. And so if, you know, Bitcoin is sound money, then the better version of that must be ultrasound money. That's where it came from.
Come on, merge. All right. Well, can you give us a price prediction? I'm actually very, very interested to hear what your thoughts are here. This will be the first price prediction ever on Web3 Academy, by the way.
That's right.
Okay. Let me just pull it.
And also, can you give us a merge prediction,
like in
terms of timing, in terms of time?
Okay. Merge prediction is easier because that's lately has been getting better telegraphed. And all this stuff, there's like, you know, the Ethereum, like all core devs calls, like anyone can kind of tune into, and they talk about the stuff that's going on. But the second thing is that like, Vitalik, I don't know, probably like 2 weeks ago, something like that, like tweeted like, we're on schedule for, you know, an August merge. So yeah, so that I'm like, if you want to assess the probability to it, I'd say like 70% certain the merge will happen in August. I'll put it to you this way. Of what I think are like reasonable estimates and the reason, or like assumptions, and the main assumptions that I'm driving at are like the percent of ETH that is going to be staked and where the daily revenues are going to be. I build towards, I think of Ethereum this way, that like you're effectively getting like a 4% staking yield, right? Think of that as like a dividend yield on an equity. You're then getting like a 1% earnings yield, right? And then you're getting, call it like a 1% share buyback. So all those things combined, you're effectively buying an asset at like a 6%, like a 6% yield. Another way to think about that, you're buying an asset by like 17 times earnings. That strikes me as really low for something that's growing as rapidly as the Ethereum ecosystem is, and has as large of an addressable market as Ethereum has. If you want some context around that 17 times multiple, Google historically traded at like a 20 to 30 times multiple. The stock market overall usually trades at like a high teens multiple. That's how I think about it.
And a price?
I was going to let the listeners infer what they wanted.
Don't worry, this isn't financial advice.
That's a good move. Yeah. There's a disclaimer at the end of this podcast.
Okay.
It'll say
all right. I was hoping the build up was going to be, more interesting of like how to think about this from a valuation standpoint. Yeah, I'm like pretty confident you could see a doubling in price between, assuming an August merge, and no other like massive macro dislocations.
Mm-hmm.
Part of the problem right now is this macro dislocation that's happening. And so this is kind of being swept, the merge is not really being seen, or forgotten about. But yeah, I could see like a doubling in price by the end of the year.
But it just means that Ethereum's on sale right now.
Well, we didn't want to turn this into like an ETH bull case, but
I mean, everything's on sale right now by the current market effects when we're in a bear market.
Yeah, I would push against that. Like, I don't view price as like an indication of value, both on the up and on the down. And I think that's one of the things that like the crypto market, this is like partly why I'm so interested in where I focus a lot of my attention in crypto, is unlike traditional markets, like there's no like real valuation heuristic in crypto, right? People are just like, oh, it's going to go to the moon. Like, this is incredible. It's going to do all these things and then more. And it's like, it's amazing. And you're like, yeah, but like, we got to somehow ground that in reality. And the other thing is like, oh, it's cheap. It's like down 60% from its highs. And you're like, well, if your price was not necessarily an indication of value, then like just because it's down doesn't actually mean anything.
That's a good point. Any more, Kai? Any more questions before we
That's it for me. Let's wrap it up.
Yeah.
All right. Well, we've gone so long. I'm not going to do the speed round. I just want to jump right into where people can find you, Sam. I know you've written some great articles, so I just want to give you a chance to do your show and to tell people where they can find you and how they can reach you.
Sure. Best to reach me on Twitter. My handle is Samuel M. Andrew. You'll find, links to my website, which is samuelandrew.com. And then from there, you'll find all sorts of articles, tweets about, a lot of the stuff we're talking about. And yeah, reach out. If you've got a different view, or you think something I've said was off, even more so, if you think something I've said was off the mark, please come and prove me wrong and correct me, because I make mistakes and things, but I'm pretty confident in these numbers I've outlined.
Amazing. And we'll put all the links.
Hit me up.
We'll put all the links in the show notes. And starting next Monday in our Discord community, for those listeners that are in there, we are doing a weekly podcast discussion. So in the Discord on Mondays, we will have an open conversation where we break down the podcasts from the previous week. So we'll be talking about this podcast today, as well as the podcast that was released on Monday, which dove into some of the similar concepts that we talked about today. So if you are a listener and you have questions, or you're not sure how to digest some of the content, or if you have another viewpoint, we'd love to have you in the Discord for that discussion to dive deeper into these topics.
You know what time that's at, Jay?
That is at 7 p.m. Eastern on Monday.
Awesome.
I don't know the rest of the time zones of the world, so I hope everyone can. Time zones trip me up. So,
well, Sam, thank you so much for joining us today. This was incredible. It's great to get someone from the financial world on, because we've never done that before. So it's good to hear your take and to see that you're kind of coming up with these numbers, and we can actually see if these blockchains are actually profitable or not, and to bring some good merit to it. So thank you for joining us, and thank you for sharing everything you're sharing in your newsletter.
Yeah, it was a pleasure, guys. It was a lot of fun, and I hope all the listeners find this interesting. And hit me up if you got any questions.
Take care, everyone. Thank you for listening to Web3 Academy. We hope this helps you along your Web3 journey. And if it does, please share this episode and subscribe so you don't miss the next one. By the way, if you've yet to join the Discord community, you are missing out. This is where all the magic happens. This is where we learn, where we ask questions, where we network. You want to be in there. The link to join is in the description below. And finally, a quick disclaimer. Nothing in this podcast was financial advice. Crypto and Web3 can be risky. You can literally lose it all. In fact, if you invest on account of what we say, you probably will lose it all. So don't do that. In all honesty, the point of this podcast is to remove the noise of markets and price and focus on utility and implementation anyway. So you should not take any of this as financial advice. Thank you, friends, and see you in the next one.